Hello, this is Quanway Invest. Everyone needs to own high quality compounding machines. When it comes to your compounding machine, the duration of ownership should be forever because all these different companies, they can keep compounding and compounding and give you incremental returns over time. As for when exactly you should be selling your compounding machines, normally you sell it only when the fundamentals change or when the competitive landscape changes. And so for today's video, I'll be talking about how exactly you can go and find your compounding machines, what traits they have, as well as some examples to find all these different compounding machines. So the first trait for all your different compounding machine is something called pricing power. So pricing power is the company's ability to raise prices at levels above the rate of inflation without pushback from consumers of the product. So take for example FICO over here. FICO's credit score in 2017 was around 35 cents. Currently in 2025 it's upwards of $4. It's around $4.50. So they basically more than 10x the prices in the span of 8 years, and the volumes have been increasing during the same duration as well. Next company is Hermes. So Hermes is the luxurious bag company that sells your Birkins, your Kellys, and all the rich people, they won't stop buying the bags even if Hermes were to increase it, let's say 10, 20% or so on every single year. So for Hermes over here as well as FICO, these two companies have incredible pricing power because even if they increase the prices of their product, the demand is still there for the product and the volumes won't decline. And so for all your different compounders, you want companies with pricing power so that they can beat inflation in an inflationary environment. And even if there's some sort of economic slowdown in the general markets, all these companies, they'll be able to raise prices to cope with the volume decline so that they won't be as affected as other companies. So when you look for companies, the first thing that you need to look for is something called pricing power. Next one is something called operating leverage. So operating leverage is the company's abilities to increase margin over time, have a higher take rate of its revenue, and improve the efficiency of the business. So if you're to look at Visa over here, this is Visa's operating margin over time. It went from around 45% in 2010 to now upwards of 60%. That's just incredible because if this company's revenue stops growing, if they can just continually just improve margins over time, increase the efficiency of the business, then the earnings will be able to improve over time already. So there's no need for all these businesses to continually increase revenue at around 20% if they are able to increase their margins as well. Because if let's say you have this company that grows 10%, if it can improve its margins by 3%, that is already a 13% earnings growth already. And so for all these different companies that have operating leverage, it shows their dominance in its space. So if a company is able to increase its margin in a space without losing market share, then that is just incredible. You should be owning this kind of businesses. Next one is something called organic growth. So for organic growth, what I'm talking about is growth that originates from the core business instead of companies basically growing through acquisitions and so on. So you don't want companies to basically do a lot of acquisition because it will dilute their core business. And so if you're to look at, let's say, healthcare companies versus a company like FICO, FICO hasn't done much acquisition. FICO is still the same business that it is maybe 20 years ago. For all your different healthcare businesses, the way they grow is they buy other businesses and then they start they basically invest into those businesses so that they can grow and so on. So for example, let's say Elevance Health. Elevance Health, they do a lot of acquisitions for your Carelon side of business. United Health as well, they do a lot of acquisitions to help with Optum Health. So for all these healthcare businesses, these are non-organic growth. These are not growth that is basically attributed to the core business, and that's what you don't want for your compounding machines. You want compounding machines that are able to grow organically without having to acquire other companies. Next quality is something called capital light. So you want your compounding machines to be extremely capital light. So you want lower R&D costs, you want lower reinvestment rate, you want low capex as well. And that's what I don't like about big tech. So if you are to look at all these big tech companies, Amazon, Google, Microsoft, Meta as well, all these companies have incredibly high capex. And if those capex don't pay off, then it's a bit risky for all these different businesses. So if you're to compare to, let's say, S&P Global, Moody's, MasterCard, Visa, these four businesses, they have incredibly low reinvestment rate and they're still able to grow its organic revenue at around 10, 12, 15% even. So for all these different businesses, for all your compounding machines, you want to find those compounding machines that have extremely low reinvestment rate, extremely capital light, so that they don't have to do anything and they can just continually grow throughout the future predictably without having to innovate. Next one is your management. So when it comes to your compounding machine, you need to take note of the management of the business. So management can normally just do three things when it comes to capital allocation. They can give dividends, they can do buybacks, or they can do acquisition. So normally when you want to basically own your different stocks, you want companies that basically do the first two instead of the third one, because acquisition is prone to mistakes, whereas buybacks and dividends, they are just mistake proof. So for all your different businesses, you want them to do buybacks so that as you do buybacks, your shares outstanding drops, and then for the same earnings, your EPS actually rises. So for example, this company over here, this company is Booking. It is not an extremely high quality business, but I love the capital allocation of this business. It has dropped its shares outstanding from around 50 billion shares outstanding 50 billion shares outstanding to now around a 35 billion. So that is around a 33% decrease already for this business. So for Booking over here, if they can continually do so, continually reduce the shares outstanding, then the EPS will be able to grow at an incremental rate, and that is what you want for your compounding machines. That is the best way for them to allocate capital. Let's talk about poor companies right now. So for poor companies, what they are is they are companies that grow inorganically. So companies that grow through acquisitions, like for example, just now we said the healthcare companies, or even companies that are trying to actively seek acquisition. So for example, let's say Adobe with its Figma acquisition and all the other acquisitions as well. Next one, you don't want companies with intense competition. So let me give you some examples of companies with intense competition. Number one is Adobe. Adobe has Canva and Figma competing with it as well. And then there's Gen AI, which could disrupt the business as well. Another portion is your caffeine segment. So your caffeine segment, you have Starbucks, Luckin Coffee, you have all your different energy drinks as well, like your Monster, Celsius, Red Bull as well. All these different businesses in the drink segment, they are competing with each other for market share. They are competing in the caffeine space, and that's what you don't like for your businesses as well. Last example is your apparel and your sportswear. So Nike, Adidas, Deckers, Lululemon, all these different businesses, they are all competing in the same segment, and that is what you don't like. So normally you want to find companies in monopoly or duopoly position. You don't want companies that are in oligopolistic position, and that is intense competition. Next one is companies with unpredictable free cash flow, earnings, and lack of growth. So when you're looking at the chart itself, when you're looking at the fundamentals of this company, you want companies that are able to basically just go in a straight line upwards. You don't want bumpy roads up and down. That is what you don't want for your companies. Last one is you don't want companies that are commoditized, because when they're commoditized, they lack pricing power. So for example, some segments that basically are commodity segments are your energy segment, your automotive segment, your airplanes, your aircraft, so on. So for example, let's say Berkshire bought Oxy. I'm a bit confused as to why he keeps buying Oxy, because Oxy is a company that sells oil, and oil is extremely commoditized. There's no pricing power unless they have some magic formula to go and dig up the oil so that they can sell at a cheaper price as compared to others. I don't think Oxy is a very good investment for most people. So let's take a look at one example over here. This company is called Ford. So Ford is a highly commoditized business. It is in the automotive segment. So you have other automotive alternatives, like you have Tesla, you have GM, you have Nissan, Toyota, and so on all your other Japanese companies as well. So it is a highly commoditized business. It is not a very good business because they have no operating leverage, no pricing power, because they often will try and reduce the prices to gain more market share, which is what Tesla has been doing all these years. They have intense competition, and it has poor fundamentals as well. So let's take a look at the fundamentals of Ford over here. This is Ford's fundamentals. As you can see, it's a very bumpy road. So it's up and down, up and down, up and down almost every single quarter. And that's what I don't like for all my different companies. Instead, what you should be looking for is companies like this. So this is MasterCard. This is their earnings per share over the past few years or so. And as you can see, it's just a straight line, and in fact, it's re-accelerating already. So when you want to look for compounding machines, look out for all these different traits. And now we'll be talking about how exactly you can find your compounding machines. So for your compounding machines, what I do is I use this screener over here. This screener is FinViz. And for my gross margins, I'll put it at upwards of 50%. Operating margin of above 20%. EPS growth past 5 years, 10%. EPS growth next 5 years, 10%. And then the return on investment, I want it upwards of 10% as well. Actually, no, 15%. Yeah, so as you can see over here, these are the two pages that you have for all your different compounding machines. You have Adobe. Adobe, I think it faces too much competition, and that's why I don't own this company. You have ASML as well. This is an incredible business. You have FICO. You have Google, Eli Lilly. Pharmaceuticals are normally avoid for me because they are highly regulated and they face a lot of competition in the same space. And then you have MasterCard as well. Let's take a look. You have Meta, MSCI. MSCI is an incredible business, and you have Microsoft, Nvidia, Novo Nordisk, Paycom. Paycom is a decent business. Sypnosis, Taiwan Semi, as well as Visa and Wingstop. So all these different businesses over here, they have the same trait, which is they have an incredibly high operating margin, incredibly high net income margin, so that they can just basically compound and compound over the years.